In this educational video from Forex Capital Trading, we're going to look at trading strategy number 1, support and resistance. Remember, trading is all about simplicity. Profits are made from buying low and selling high, or selling high and buying low. Looking at support and resistance, there's a general theory. Support is the levels where buyers accumulate, and resistance is the levels where sellers accumulate. In the theory of technical analysis, support and resistance often reverse their roles when broken. So as a result, past support creates resistance, and past resistance creates support. Traders need to remember that levels are decided by each individual trader. They could be previous highs or lows, trendline support, or any level chosen by the trader themselves. Some traders may see support and resistance in levels where other traders don't see it. Remember to trust your judgment, because you are the one that is trading, and if you see a level of support or resistance, it's your job to trade it. So how do you trade it? Trading support and resistance is very simple. So let's start out by looking at trading support. Since there are buyers around, you want to be a buyer as well. So you buy towards support with your stop loss below support. This is because if support doesn't hold anymore and there's no more buyers, you want to make sure you close the position. On the long position that you hold, you want to take profit below the next level of resistance. Trading resistance is equally as simple. Because there are sellers around, you also want to be a seller towards resistance. And you want to leave your stop loss above the resistance, because if the selling interest runs out, you no longer want the position. And your take profit on your short position needs to be above the next level of support. So let's look at some practical examples. And remember, keep it simple, because simple trading is profitable trading. Let's start off by looking at trading support. As can be seen in the chart above, support at 159.80 is held in the sterling on 2 previous occasions, and the market is now trading back towards that level, so traders have to assume that the buyers will be there again and look to be a buyer. As a result, a trader can buy 500,000 sterling around about 159.80 or a little bit above, so at 160 the figure, leaving a stop loss below the support at 159.50 and a take profit towards the previous resistance or the last major high at 162, so you can leave your take profit at 161.80. Let's see what happened. You bought 500,000 sterling at 160 the figure, and the market rallied. You sold that trade at 161.80, creating a profit of $9,000. The important thing to note in this trade, the maximum risk was only $2,500 on the initial trade, so the risk reward has been exceptionally good. Now let's have a look at trading resistance, and again, keep it simple. As can be seen in the chart above, the sterling had a major recent high around 164 the figure, where a previous reversal was very strong. So as a trader, you can make the assumption that these levels are going to reverse again, because previously there was selling interest there in the past, so you can assume that it's going to be there again. As a result, the trade can be to sell 500,000 sterling at 164 the figure, with a stop loss at 164.5, which is above the resistance, and a take profit down towards the previous level of support around 163. So let's see what happened. You sold the 500,000 sterling at 164. The market didn't reverse straight away, and it went back to retest the resistance, but the selling interest still prevailed. Eventually the market dropped and you closed the trade at 163 the figure, creating a profit of $5,000. Again, the maximum risk was only $2,500 on the trade, so the risk reward of 2 to 1 was exceptionally good. So where to from here? Support and resistance usually holds in the first instance, and most traders make the assumption that this will occur. So if you see a level of support or resistance, make sure you trade it. And remember, it's your view of support or resistance. Trust your judgment. You're the one looking at the charts. You're the one making the decisions for the trades. So trust your judgment. Always have good risk management. As in the previous examples, there was always a stop loss, and risk was always taken into consideration when looking at the trade itself. Don't risk more than you're looking to make, and make sure you stick to your risk management policies, being comfortable with what you're risking while looking to make good money. Remember that even the best traders get it wrong and get it wrong regularly. You're never going to be 100% right, so accept that you will make some bad decisions and there will be days where support and resistance is broken. But that's where your stop loss comes in. Make sure you're using your stop loss to give good risk management and make sure your account equity is protected. Finally, get to know and use your account manager here at Forex CT. We're just a phone call away, 1-800-367-392.